Good morning, ladies. I want to just take a few minutes to welcome everybody to our conference. It was great to see everybody, or at least most of you, last night at dinner. For those that don't know me, I'm Carrie Ann Basler. I am the chair of iWork this year. And I just wanted to welcome you all to the conference. We have a great panel to get started, but before we do that, I'd like Ms. Kimball to come on up and talk a little bit about our sponsors and our sponsorship drive.
Hey, good morning, everyone. Jennifer Kimball. I'm an attorney at Lowenstein Sandler in New York, and I also serve as iWork's finance director. This conference is notorious for being where we ask for your money for sponsors for 2020. So we are right in the middle of our sponsorship drive. We would welcome your pledges to serve as a sponsor for iWork during the year of 2020. It's really strange to say 2020. Crazy how quickly time goes. I have sponsorship forms here. There are also sponsorship forms on the table where you picked up your name tag this morning. At lunch, we will be doing our annual raffle. There are 2 pairs of AirPods as well as a registration to the spring conference up for grabs for the sponsorship raffle. So if you commit to be a 2020 sponsor, you're in the raffle today for lunch. If anybody has any questions, I'm happy to answer them about our sponsor benefits. And with that, I will turn it over to Ms. Terry Friedman, our Director of Programming.
Good morning, everybody. Thanks for coming so early. This morning, our first panel is The Right Stuff, Rights Offerings in Chapter 11 Cases and Cross-Border Deals. I'd like to welcome our panelists this morning. Our moderator is Madeline Primoff from Fresh Fields. And then next to her, we have Sasha Linney from Golden Tree Asset Management, Becky Roof from Alex Partners, and Katie Trey from Barclays. So ladies, with that, please.
Terry, thank you. Good morning, everybody. This morning we're going to talk about rights offerings. I think I'll just introduce myself briefly. The panelists will do the same. Madeline Primoff, Fresh Fields, Bruckhaus, Derringer. I'm a partner in the New York office, specializing in bankruptcy and restructuring.
Sasha Linney, I'm an Associate General Counsel at Golden Tree Asset Management. I've been at Golden Tree for about 3 years, supporting the distress group and also just the trading desk. Before that, I was at Debevoise for 5 years in the bankruptcy group.
So Becky Roof, I'm a Managing Director with Alex Partners on the Turnaround and Restructuring Services Group. So frequently I am inside the company as a CRO or CFO negotiating rights offerings on behalf of the company.
Hi, Katie Trey. I'm a director at Barclays in the Restructuring and Finance Group. We specialize in raising capital for stressed and distressed companies through rescue, DIP, exit financings, and also just a variety of products in between, including distressed M&A and sort of the whole suite of Barclays products.
So with Kelly's help, we structured this panel to give you a variety of perspectives about rights offerings, from the banker perspective, the advisor perspective, the investor perspective, and the lawyer perspective. Won't go through the whole table of contents, but the purpose of the program is to give you an overview of issues that we confront in Chapter 11 cases concerning rights offerings. And a rights offering can be an offering for debt, it could be for preferred stock, common stock. Usually when you hear the term rights offering, it refers to an equity rights offering, but it doesn't have to be. So we'll talk about the genesis of rights offering, how negotiations proceed, what the key items are in negotiations, some of the securities law considerations, and some of the litigation issues that we've seen in the last couple of years. So with that, I'll turn it over to Sasha.
Thank you. So just going back to basics, what is a rights offering? And at its most essential, a rights offering is a way for a company to raise financing. What usually differentiates a rights offering from traditional exit financing that's in the form of a debt is that the rights offering is offered to the debtor's existing creditors. It's usually the Fulcrum class or the debt holders, but It could be offered to the equity as well, a little less common. And as Madeline said, it's usually in the form of equity, that is the new equity, but it could also be in the form of debt. That's not entirely unheard of. So in a rights offering, each creditor in the class that it's being offered to is given a subscription right to subscribe to the new equity. And they're offered that right at a fixed price. It's set, when the rights offer, it could be set earlier in the negotiation stage, but it might also be set, during the plan or during the case. And that fixed price is called the subscription price. And that subscription right is essentially a call option on the equity. It's a very short call option, but that's essentially what it is. So the rights offering may or may not allow people to oversubscribe for the shares. And sometimes rights offering is not taken up by everybody who's given the option. So if the rights offering is undersubscribed, there may be a need to backstop that rights offering. So usually a subset of creditors, an ad hoc group will agree to backstop the rights offering in the event of an undersubscription. And in exchange for that backstop, they'll usually receive a fee, a backstop fee. Another important element of a rights offering is that the equity is often offered at a discount to plan value to help induce those people to subscribe and to participate and to have a successful offering.
And the fee, what form does the fee customarily take, Sasha?
So the fee is usually paid in the new equity itself, and it's often hovers around 5 or 6% for those backstop parties.
So Katie, do you want to take us through some of the benefits and considerations of a rights offering?
Definitely. On the benefits side, this has really become a more standard option available for bankruptcy exit financing. And oftentimes you see it as an alternative, as we talked about. It typically comes in the form more of equity, but it's possible for it to be in other structures. But different from traditional sort of debt financing, you're looking at oftentimes no interest if it is pure equity, no covenants, and so you're looking at people that are really sort of long the business and believe and want to support it from that perspective. It's typically backstopped, and so you want to provide the certainty of funds to be able to exit bankruptcy, and that's important, and oftentimes gives investors a way to take a hard look and be able to have conviction around a situation. It also enables existing investors, regardless of size, to maintain economic ownership of their position by participating in the transaction. So it allows people to get a chance to, put their money where their mouth is in terms of saying, this is a transaction that, they believe in and want to support, and I think is also a way to manage sort of the litigation, which we'll talk about further, by giving people a chance to participate. We talked a lot about the discount, and we'll talk about it further. So, but that's one big piece of it where people are able to participate at a discount and be able to gain that as well. And another piece is the rights oftentimes can be structured in some way to be sold, which sometimes allows investors another option to realize value. And this allows them to be able to not necessarily participate and put up new capital, but sometimes be able to realize value and sell it to someone that has more interest in putting up the new capital. On the flip side of it, for the consideration side, while we talked about this has become more standard in bankruptcy and oftentimes with stressed and distressed investors, there can be the possibility that the rest of the investor base may not be as familiar with it, as these aren't used as frequently outside of bankruptcy. And so it's something where you might have a whole education process for your investor base and make sure that they get the opportunity, know how to subscribe to the rights, and work out that whole process. The other piece is very key in terms of the limited ability to bring in new investors. It sort of requires people who want to be a part of the process to have bought in to the existing capital structure, whether this is open to creditors or it's open to existing equity holders. That's a big piece of it. They sort of already need to be in the mix and participate. Otherwise, they're sort of looking at it afterwards. Or, you know, they're able to pick up the rights somehow if they are transferable. There's limited visibility on participation until close of the subscription period, so that matters in the sense that, you know, you have the backstop capital committed, so you're not as worried about it from a capital perspective, but oftentimes it doesn't give you the best look into ownership percentages, who is going to be driving the business. You have a view in terms of oftentimes like ultimately, if everyone plays, this is what it looks like, and if no one plays, this is what the backstop parties own, but there's sort of anything up for grabs in between, and so oftentimes it's a little bit of a black box until you reach that final end of the subscription period. And finally, back to the discount, it often creates a substantial dilution for parties. We'll talk about the ranges and show you some cases. But oftentimes you can see, you know, pretty dilutive sort of discount values for parties that don't put up new capital to do so and basically get diluted in the process.
So, Katie, you mentioned that one of the advantages for the company of the equity rights offering compared to debt is there's no collateral, there's no covenants, so that gives the company a lot of flexibility. But in terms of the backstop parties and control, what do you tend to see there?
Yeah, I think, you know, on that side, certainly these transactions can at times be coercive, and you're sort of looking at it from that perspective. But oftentimes it gives everyone a chance to participate and be able to get this discount to sort of a plan value that's agreed upon, and be able to take, you know, more ownership of a situation in terms of the fees and the participation of it. And so oftentimes it's a way that people that are very excited about a transaction and want to be long are able to participate.
Okay, so Sasha, can you take us through the genesis and some of the inducements that a rights offering can
Yeah.
provide?
Sure. I think from the investor side, you know, I've seen rights offerings, and I'll be interested to hear what Becky has to say from the company side. But oftentimes a rights offering or the idea of a rights offering will start to form even before the filing of the case, right? If we know that there's going to be a restructuring, it's probably going to be a Chapter 11. You know, typically an ad hoc group will start to form, and those people are in an especially advantaged position because they are able to, in a way, dictate the terms of the rights offering in consultation, usually with the debtor's counsel as well.
Not always.
Sometimes, yeah. And so that's usually, in my experience, how they at least start, right? And in some ways, rights offerings can be used coercively, right? So if you want to get a certain impaired accepting class to vote in favor of the plan, oftentimes the rights offering with its discount to plan value can really, with that sweetener, can really induce people to want to participate. And so you can have sort of a death trap situation where you can require people where people can only participate in the rights offering if they also vote on the plan of reorganization.
Becky, did you have a
No,
comment?
nothing about bankruptcy is ever coercive. It just doesn't happen. No, I think it's interesting because, you know, frequently the rights offering is already being negotiated by the time, you know, my firm gets into a company as CRO or as advisors. And it's very critical for us to insert ourselves and the company to be inserted into the process as early as possible. You know, very frequently a rights offering is just an extension of a loan-to-own strategy. And that means that whoever is going to be the backstop party is probably going to end up controlling the company upon emergence. And so it's really important for the company to be part of the process so that they can influence, if at all possible, who their new owners are going to be. These are going to be the people that are going to have board seats. You're going to be living with these people for a long time. And so whatever the company can do to have influence over who gains control through a rights offering, you have to start early. It's also critical for a company to understand what values are so that the discount can be negotiated, reduced. The company has to, be an advocate for all stakeholders, not just whoever is going to be a backstop party. And also, the company has to have a very early view on how much liquidity is needed upon emergence so that the rights offering can be structured at the right level. So those are some things that, I think about, as soon as we get involved in a situation. And I want to make one more point, because Katie, you talked about transferability. There's nothing worse than negotiating your whole plan and then find that the person who was either a majority, going to hold a majority through the rights offering or be a backstop party, you're almost done, and then they trade out and you start over. So you have to be aware of transferability from the very beginning.
And we'll touch on this a little bit later, but another reason why you need to be aware of transferability is because sometimes the rights themselves can be detached from the underlying debt. And in fact, that can cause issues because usually rights offerings enjoy the benefit of an exemption from securities registration laws through 1145 of the Bankruptcy Code. But if the debt and the rights do not trade in tandem, then you often lose that benefit and that exemption. We'll touch on that later. But yeah, just to reiterate what Becky said, I think there are a lot of elements of a rights offering, such as transferability, that are solidified very early on in the negotiation process. Will there be oversubscription rights? What is the backstop fee going to be? Transferability, all of those issues are really important and often get decided very early on in negotiations.
So we're seeing an increased incidence of ad hoc creditor groups forming very early on, and they'll have a control position for Chapter 11 purposes, and they will serve up the terms of a plan to the company. And Becky, I'm interested in your thoughts on this. From a company perspective, what do you do if your key creditors' constituencies show up at your door and say, okay, this is the plan that the debtor is going to do?
Well, frequently the discussions are quite animated and loud. You first of all, you've got to be prepared, and it's unfortunate when a company doesn't hire restructuring counsel and advisors early, and this is where the ad hoc committees get ahead of the company. And sometimes, you'll read about an ad hoc committee in DebtWire and go, uh-oh, guess I should be interviewing advisors. You've got to, I don't want to use the word fight, but you've got to come back with facts. You've got to know what value is. You've got to have a plan. I mean, you have to have an end game. And then if they're wrong, you try to convince them with facts. But if they're already that far ahead of you, you have lost some negotiating leverage. There's no doubt.
Okay, so let's get into the typical structures of rights offerings.
So I'm going to run through this pretty quick, only because I feel like we've touched on a lot of these pieces, and the interesting part is how all of this gets negotiated. But as Becky touched on, the amount is certainly important, and obviously that's a key term, but I think part of it is given the discount value that's being calculated, you need to make sure that, as you're thinking about valuation and the amount of money you need in terms of liquidity and funding the case and paying out everything in order to exit, as well as the discount value, you're really looking at how much equity is truly coming into the business, how much money am I going to have, and so all of these sort of play in tandem to get you to the right place to figure out the sizing that you need. The plan value is also important, like I said, and factors in from a valuation perspective because you're often doing this at a discount to plan value and you want it to be able to tie into ultimately what your valuation of the case is. This is typically provided by the company advisor as part of the plan of reorg process, so it's all sort of iterative between these different pieces. The discount, which we've seen somewhere in the 20-30%, but could be more, could be less. The premium
Completely egregious, usually.
sometimes, only sometimes. Premium and fees also potentially egregious, depending on the case and where it is. But typically includes a backstop fee. As we mentioned, you want to have a party or a series of parties backstopping this, or a commitment fee in some form. Original issue discount, OID, is also important, and that's where the investors get a discount and basically fund less and get that sort of in the discount to plan value way, but ultimately another way for them to take value out up front. And also an important piece of it, just in the event that the plan sort of moves a different way or the transaction changes, but having to sort of step up and commit to this structure, a breakup fee or a termination fee are also important to consider as well. Transferability, which we've talked about, that's another piece to be negotiated on how that looks and fits into the plan. The participants, and I think this is sometimes where a lot of the litigation happens, and also, is a big focus, as it really drives in terms of who, is larger in the situation, who's able to be part of an ad hoc group, and part of that formation, as oftentimes they're the ones driving the backstop, and that's where a lot of the juice and sweeteners come in, more so than just being a regular participant. So there's, a lot of sort of infighting at times or negotiations between, ultimately the backstop parties as well as the participants. And use of proceeds, always important to know where that money's going.
Okay, Sasha, you want to take us, spend a minute on the documentation supporting the rights offering?
Yeah, I'll run through this quickly. Like I said before, rights offerings can often be contemplated very early on in the case and can appear in a restructuring support agreement. In any event, they're going to be set forth in the plan of reorganization. In the disclosure statement, obviously the most important part of that will be the valuation, right? Because that will then set or help set the discount to plan value that's offered. The subscription forms are the forms that go out to everybody in the class who's being given the opportunity to invest. And I'll just note here, in addition to kind of being very prepared early on in the case and for debtors to be proactive, if you're representing a debtor in a Chapter 11 that's doing a rights offering, it is oftentimes, you're taking the regularly stressful circumstances of emerging from Chapter 11, and you're adding on this new financing, and oftentimes you don't know, as Katie said, until very close to emergence, exactly what percent of the rights offering you're going to have as an investor. And then, of course, the backstop agreement, which will lay out the backstop fees and the discount to plan value and everything, and that will be between the backstop parties and the debtor.
Thanks. Okay, so let's get into the meat of it, the negotiated deal points. Katie, you want to kick off on valuation?
Yeah, so I think you're seeing a lot of the different pieces of the presentation funnel together. Valuation and really size together come into play. And so it's important as you're thinking about the liquidity of the case, and sometimes that changes, over time. So I think from a company perspective, it's really important to have a handle on how, you're seeing the liquidity shakeout. Becky, I don't know if you have a view in sitting on the company side.
Well, I'm always intrigued how someone has set the valuation without doing a valuation of the company, and then I love watching the bankers scramble to come up with a valuation that was just kind of, to me, it appeared to be pulled out of thin air. So, sorry about that, bankers in the room, but it's really the way it works.
Yeah, I think it gets back to the point of, how the cases run, when the ad hoc groups are formed. Sometimes, funds have just coalesced to this view, and they're like, this is what it's going to be, this is what we're planning to fund, and oftentimes they're the biggest parties in the case. So you're looking at it and trying to figure out a way, that this works for all of the other stakeholders, because certainly there's a negotiation aspect to it, and you're not just takers. You have to look in the best interests, but I do think this gets to the point of sometimes it's a tricky situation because, the company and management certainly is looking at this and saying, these are my future owners, probably. They're also potentially going to control the board, drive all of that. And so the balance between like wanting to be helpful and supportive and sort of align yourself with one horse versus sort of like pushing back really hard as well. And so, it oftentimes gets into a bit of a dance trying to figure out these different pieces.
And traditionally, it's made sense a lot of times as to the different motivations of the different constituencies, debtor, secured lender, bondholders, as to who's arguing for what valuation. The motivations behind those arguments have traditionally been pretty clear. But as with the emergence of crossover lender groups, where people are playing both in the secured debt and the unsecured debt, and you don't know, it's not necessarily apparent whether they're motivated by their secured lender holdings or their bondholder holdings, it makes things complicated.
And these are expensive. So when you're looking at the sizing and liquidity, I don't know, I always figure out what I think we need and then multiply it by at least another 10 or 15% because so much goes out in fees. And you're paying for everybody, not just the fees associated with the rights offering, but you're paying for all the lawyers, all the advisors. So it's just important to keep that in mind.
And just, to wear the investor hat and to defend the backstop fees, from the perspective of an investor. From the perspective of the investor, right, even though rights offerings may only be held open for, say, 3 weeks to the class, oftentimes the backstop party commits to backstop far in advance. And really, these are also dependent on the facts of the case, and you may commit to backstop at a time when people perceive the value of the company to be very low. And so not only are you locking yourself in and committing to backstop, but on top of that, you're losing the opportunity, the time value of money to deploy your money elsewhere.
Fair points, absolutely.
So let's talk about the discount, because that's one of the more interesting features of the rights offering. So how does the discount get negotiated?
Well, again, I think it can range from no discount to, in some cases, 80%. We've seen as high as 80%. And the next slide will have a comparison of that. I think, again, it really depends on what people perceive the value of the company to be at that time and how many inducements you need to put into the rights offering to get people excited about it. So I think that's really what it comes down to.
And then, participation and transferability, I think we've covered. Katie, you want to talk about governance rights?
Governance rights are always very key as well, and certainly in terms of the board trying to figure out who is going to be driving, those pieces of governance. I think the interesting thing here is, oftentimes because you have an ad hoc group, you have a couple different players, and we talked about, not necessarily knowing who is going to own, the most at the end, but typically it still ends up being your ad hoc group who are the larger holders. But sometimes there is a balancing act too between them of like, how many seats will each of us be putting up, sort of balancing. You start having the issues of balancing between the group itself, and there's the added layer of obviously the company and trying to negotiate from the company's best interest. So I think, sort of looking at what those rights are between the company, the future owners, and then also within the owners themselves. And oftentimes you see a lot of negotiations happening behind closed doors between the ad hoc group members as well.
And this is the point where you try to insert management, because this is their opportunity to negotiate what they're going to get on exit. And this is usually the point in time where it's a wake-up call to management, how bad off they're going to be, because they may be used to having, they're in control of their own compensation. They may have large equity ownings that are going to get, wiped out, and they're going to get a very small percentage of the emerging company under a typical rights offering structure. So this is really the aha moment, and it's a bad aha moment for management.
And then this chart, the numbers are maybe too small to see on the screen, but this is a chart that goes through maybe 20 different deals that we've collectively observed over the last 2 years. And what's interesting is that it shows the size of the rights offerings out in the market. Peabody was $1.5 billion at the top end of the range, and it gives a flavor for what the discount was to plan value and what the backstop fee ranges are. We'll just spend a minute on securities law considerations. So I'm sure you're all familiar with Section 1145 of the Bankruptcy Code. So that will generally provide an exemption for securities issued in connection with the rights offering, because they're viewed to be, at least in part, in exchange for your interest in the company or an option to purchase, so that your initial purchase as well as a subsequent transaction involving those securities is generally exempt. But then the securities issued in connection with the backstop don't get the benefit of the 1145 exemption. So the debtor will usually rely on a private placement exemption for the backstop securities. And then if the backstop parties seek to sell their shares at some point in the future, they'll typically have a registration requirement in the documents that they can compel the company to register. But this gives rise to a broader issue, which is if you're a large player in connection with a rights offering and you're subscribing for 5% or more of the company, then you may be deemed under securities laws to be a control person. You may have obligations. So that's something that you wouldn't see in connection with a typical debt financing. So that's something that people need to be mindful of.
And can I just give an anecdote there?
Yeah.
In a recent case, we, it's Hexion, I mean, it's all public, but we were going to be getting around in the neighborhood of 10%, we thought. We didn't really know until all of the subscription forms came back in and we saw how much we would have to backstop. And, if you're a 10% or more holder of a company, you can be deemed an affiliate, and that comes with all kinds of burdensome reporting requirements, et cetera. And so in Hexion in particular, we incorporated warrants into the rights offering. So anybody, and we weren't the only investors in this sticky situation, and so we actually took warrants to reduce our equity holdings to below the key 10% threshold. So that can be a tactic that can be helpful for people who want to get exposed, who believe in the company's future, but aren't prepared to step in and be an affiliate under securities law.
So we'll talk about some of the cases, and we want to save time naturally for questions. Most of the litigation involving rights offerings have centered around the 1123A4 issues about equal treatment, equal and ratable treatment of creditors. And that litigation really comes down to whether the backstop parties or the people participating in the rights offering are getting treatment on account of their existing claims in the bankruptcy, or whether this is something new, separate and apart from a recovery on their existing claim. And the cases have generally trended in favor of saying this is something new, and therefore the backstop itself does not need to be made available to everybody. So that's just an overview of some of the themes we see in the cases. Sasha, you want to kick off on Peabody?
Yeah, sure. So Peabody is one of the more well-known cases in rights offerings, and it was just recently an Eighth Circuit decision came down about it, basically affirming what the bankruptcy court had said. So in Peabody, this slide focused particularly on the private placement. So there was a $750 million private placement, and then I think a rights offering of the same amount. And so the opportunity to participate in the first phase of the private placement was limited to just a subset of note holders and claimants who, were true proponents of the plan from the beginning, right? So they were given the opportunity to acquire 22.5% of the equity. Then in the second phase, the rights offering or the private placement was opened up to more parties, and so it was opened up to plan proponents who signed the backstop and also signed the plan support agreement, and that was an additional 5% of the preferred equity there. And then in the third phase, it was offered, the remaining 72.5% was offered to all signatories of the backstop and the plan support agreement. And so you really see how people who are involved early and who are the more sophisticated players get to benefit from this, it notes here the profit for those participants was between 90 and 113 million. So it can be really beneficial. So there was an ad hoc committee of note holders who did not participate in the capital raise. And to what Madeline said earlier, they objected to the rights offering on the basis that it treated similarly situated creditors differently. And again, this goes down to the question of whether the rights offering is a distribution on account of their claim. And the bankruptcy court decided in favor of the plan proponents and overruled the objections of the ad hoc committee. The district court basically just said it's equitably moot, pass it on to the Eighth Circuit, and the Eighth Circuit just a few months ago, as we were starting to prepare for this panel, affirmed the decision of the bankruptcy court and allowed didn't unwind the plan. I think it's a really important case because it is probably going to lead to even more rights offerings, right, when people feel emboldened with this decision behind them. Even though, it's Eighth Circuit, not that many cases are filed there, but I think it's going to have a lot of influence in other cases.
Yeah, I agree with that. I mean, this is a Court of Appeals level authority that's saying it's not an 1123A4 issue, and that the ad hoc is entitled to do this. And the spirit of these cases is that if a competing group wants to come along and make a competing rights offering on better terms, there's nothing stopping them from doing that. That's the theory. You can go find your friends and you can put forward your own rights offering. But the trouble is that the backstop group is often comprised of creditors that already hold in excess of 50%. So who, as a practical matter, who are you going to find out there to team up with you? I don't know if you guys have another perspective.
I think it's a fascinating decision, and I think it's going to create some havoc.
It is, but I think it gets back to, I mean, we discussed these being coercive at times, expensive, but some of the other alternatives where companies don't have rights offerings available to them are debt financing on the back end of it, exit financing that, oftentimes is very heavy interest, and you see creditors want to have that comfort of take back paper, prevent, a future sort of Chapter 22 and give themselves additional cushion from that perspective. And that's not always great for the debtor as well. So it's sort of threading a needle between, it being coercive and dilutive to the parties, or potentially, there not being equity capital available. So, it's one of those things where you really have to look at the case and figure out what is right for the situation and also what your opportunity set is.
Yeah, Katie, and you made the point to me yesterday that nobody's going to sign up for a $200 million, to backstop a $200 million rights offering, despite the fees and all of that, unless they really do have faith in the future of the company. So I think that's an extremely valid point.
And another thing I'll just note in terms of, where the parties have leverage here is that some existing debt holders aren't even able to take or hold equity. And sometimes they have no choice, right? They're going to be equitized. But they're missing out on the opportunity of the discount because their hands are tied, because maybe they're foreign holders and it's a real property holding company, and the tax burden on that equity would just be too high for them to really economically participate and have it make sense.
So the next case we'll talk about is Pacific Drilling, which was in the Southern District of New York in front of Judge Wiles. And what makes this case interesting is that nobody was objecting to plan confirmation. The plan as originally conceived by the ad hoc group and the debtor had a $500 million capital raise. $400 million of it was in a rights offering and $100 million in a private placement, both at a 46.9% discount to plan value. And the judge basically just told the parties that he didn't think they needed the private placement. So they went back and came back with a transaction structure that had a $460 million rights offering at the same 46.9% discount, with some pretty generous fees to the backstop group, 8% fee. And the judge on his own expressed all sorts of reservations about the rights offering, but then ultimately said, okay, well, there's nobody standing here in front of me objecting, so I guess I'll approve it. Ultimately, they conceded on the fee, that they would only charge the fee on the piece that they actually ended up backstopping. So that's some area for negotiation.
Yeah, and having been, we were a holder in PAC-D, and we weren't part of the ad hoc group because we didn't have, I think the threshold to really get in the ad hoc group was set at least 50, if not 100 million, and we didn't have that size of holdings. And so even though there was nobody standing before Judge Wiles in the courtroom, it was hotly sort of negotiated, contested, and a lot of people who were kept out of the backstop, including my firm, made a lot of noise, and this is the delicacy of it. It's like people you deal with all of the time, the repeat players who are typically in these ad hoc groups. And so you want to play nice in the sandbox, but at the same time, if you're ready, willing, and able to step up and you think you want a piece of that backstop, what's the reason for an ad hoc group to keep you out other than they've been in it for a while and they've done all of the hard work to negotiate, to form the restructuring support agreement.
And that's really the perfect segue to Parker Drilling, which was the terms, while the rights offering was smaller, the terms were almost identical to plan discount and fees that we'd seen in Pacific Drilling. And you had people that wanted into the backstop, and the backstop group said, no, absolutely not. Basically, they said, we've been working on this for months, and you can't come in at the last minute and just ask to be in our backstop. So their parties did object, and what the court found at the confirmation hearing was that the backstop parties had signed up to the backstop in December of last year, which the court found on the record was the absolute low point, trough in the energy markets. And he thought that so it was Judge Isker in Texas, and he thought that was a valid basis for the backstop and the fees. So that supports your point from earlier, Sasha, about the risk that the backstop parties actually do take.
Mm-hmm.
And then we'll talk about there's an increased use of backstops in cross-border deals. I'll just spend a moment on Oi. So Oi was an enormous case in Brazil. I know we've got some people here from Brazil, so welcome. And there were, because of the size of the case, a lot of the players were U.S. folks. So you had U.S. funds who had bought into the debt, and you had U.S. advisors involved. So the rights offering in Oi looked very similar to a U.S.-style rights offering. So we're seeing these capital raising techniques being exported around the globe. And then, Becky, do you want to talk about CGG?
Yeah, CGG was a really interesting case. It's a seismic company that was headquartered in France with its U.S. headquarters in Houston. And so when we undertook this restructuring, we filed what's called safeguard proceedings in France in Chapter 11 and Chapter 15 in the U.S. And in France, a mandataire ad hoc, and I probably butchered the pronunciation, but this individual is appointed by the French court, and this is like being a CRO on steroids. I mean, it was great. And Helene was really, really tough, but she herded, all of the cats in the case. We had 5 different stakeholder groups. We had secured lenders, we had the ad hoc committee of senior notes, we had convertible bondholders, we had a institutional shareholder who was also in the high yield bonds and the convertible bonds, and then under French law, shareholders get to participate. And so what we crafted was a rights offering to allow the existing equity holders to backstop a rights offering for liquidity so that they could maintain a larger share of the company on emergence. And it's unusual to have a rights offering. I don't think you'd have that in the U.S., but there were shareholders who signed up, and they put up $125 million U.S. And then we were able to reinstate the senior debt. Interestingly enough, the high-yield bondholders did not do their new investment, their new money, in the form of a rights offering. They just came in, directly as an equity investment. So cross-border can be unusual, but it can be done.
We want to leave time for questions. We've got a slide on lessons learned, but why don't we do questions first?
Carrie Ann.
When you showed the slide that had all the variety of different deals at the discount to plan value, there's a significant amount of those that have not just 10 or 15, but 30, 40%. Do you see that continuing to happen? Because it seems, especially, you mentioned Judge Wiles, where you get in front of the judge and they say, you get this fee and that fee and a 45 to 50% most of the value. That's the same thing.
Well, I think that, The question was on the slide that showed all the values and the discount fees, and some of those discount fees are quite large. Do we think that's going to continue? I think that people are going to pay more attention to it, but value is also in the eye of the beholder. And so I think you have to understand how the underlying value was set and how that intersects with the discount on the fee, the amount of risk involved, the amount of time it's going to take, to Sasha's point. So it all intersects. But I do think that these recent decisions are going to make people think a little bit harder about how they do the whole structure and not just the discount fee.
So that's a principled response to the question. There's also a practical response to the question, which is that in most of the cases where we see these rights offerings, the trade is riding through unimpaired, that they'll get paid. So it really begs the question of, and you often don't have a committee, or the ad hoc group could be dominating the committee. So for somebody to challenge this, they've got to be self-funding, and much of the time, and it's just too big an undertaking for an individual creditor to take on, to challenge valuation and discount. You need experts and financial advisors. It's a very big undertaking.
Choose your venue wisely.
Pardon?
Choose your venue wisely.
Yeah.
I think after Judge Wiles' sua sponte sort of pushed back on the fees in Pacific Drilling, I think a lot of people's ears perked up, and it was seen as a shot across the bow, kind of a warning that we're watching.
I mean, I think it really will take a U.S. trustee type to say, wait a minute, I'm the watchdog. I should be paying attention to this.
My question is, where you're seeing the high discounts, are these in situations where the rights offering negotiation happened, maybe price was set prior to actually having the plan of reorganization? Because as was mentioned, discounts and all that are typically a measure of risk.
I mean, I think that's what happened in Parker, right?
Right.
That's exactly right. All of this is so fact-dependent, but also timing and sequencing dependent. So on the slide where we had all of the comparables, there are a lot of oil and gas cases in there because there have been a lot of oil and gas cases recently. And so there were plenty to pick from. But that especially is a very volatile market. And so you might, or look at what happened. We're not talking about Ultra here, but in Ultra, by the time the company emerged, they were solvent, right? Because gas prices rallied. And so that's an absolutely, excellent point, that it really can depend on the timing. And, people are getting through cases faster and faster. They'll say that we come out confidently, we're going to get through in 3 months, and you hope that valuation doesn't change that much. But the longer the case goes on, the more fortunes could change, either for the better or for the worse.
I mean, you'll also want to have a restructuring support agreement that has the backstop signed up alongside of that, so that you know what you're doing, and you don't risk, what Becky referred to earlier, and having your transaction blow up. So, that's the reason there may be some period of time. If you can get the backstop committed and the restructuring support agreement signed up, you still, as a practical matter, need some period of time to get plan disclosure statement done. Yes.
Terrific panel, thanks very much. And I say this not just because I went to high school with Madeline. But thank you. My question is a legal question, and maybe it's answered by the Parker Drilling case, which I look forward to reading. But even if the participants in the rights offering are giving something new that it's not something on account of their existing claims. If the rights offering isn't offered to everyone, but like in Peabody, only offered to discrete groups exclusively, it would seem that that exclusivity, consistent with LaSalle, is value, quite apart from the offering itself. And I'm wondering if there have been, is that what the Parker drilling case is about? And are there any other opinions that have addressed the exclusivity factor of a rights offering from a LaSalle perspective or anything like that?
So Parker was focused on whether the right to participate in the backstop had to be open to everybody. And I think that's the only case to address that issue. And there, Judge Isker in Texas said, if you want to have a competing rights offering, you can have your own backstop. I agree with you. It's the exclusivity point that is disturbing, but these are the universe of cases, and the question will be whether it's a U.S. trustee or creditor groups who are willing to come forward and take these issues on. But we do think we're going to see, hopefully we see more and more of this, because we're seeing more and more rights offerings being advanced.
Yeah, and I think had people stepped up and objected in Pacific Drilling, we might have gotten an opinion along the lines that you're hinting at. I think Judge Wiles was prepared to write an opinion like that. But another big issue that we haven't even touched on in terms of timing is, when do you even object to a rights offering? Because oftentimes they're negotiated very early on with a small group of people, and they're not made public until later, so by then it's too late.
Right, and then you combine a rights offering done really early, like pre-petition usually, right?
Right.
With equitable mootness, and then it's just exclusivity on steroids.
Yes.
Yeah, exclusivity on steroids was just, I'll repeat that back, I like that. But yeah, that's exactly right.
Okay. Well, thank you so much.
Thank you very much. Great panel. So we're going to take a break now and come back at 10:15. Thank you.